to everybody who's joined us. Thank you so much for joining this evening. I'm glad everybody's hanging in there and well at this point. As you know, we have canceled all of our pods. Hopefully those will all be back in 2021. That being said, there's no meeting in December, so the next time we will meet will be in 2021, and hopefully those pods will be back in business, and we will keep you informed as to whether or not those are available. January meetup will be about moving your business forward, even through all these crazy times. We do not have a speaker at this time, so if you know of anybody, let us know. Feel free to suggest anybody and send us their contact information so that we can touch base with them. And then we also want to make sure that everybody is still visiting our Facebook page. We have a bunch of new members that are signed up all the time. That's very encouraging and nice to see. But what would make it even better is if, you know, we had that dialogue going and everybody was kind of putting their questions and I guess just providing advice and answers to people for the things that they're posting. So to make our community a little bit stronger and more engaged. I think that's about my part. I'm going to turn it over to Mark.
First thing is I just got a text from Nate to remind me to ask if we've had any do we have any first timers on the Zoom meeting right now? Anybody?
No way. Tina's waving, Sam's waving.
Got a couple people. If you do, please introduce yourselves. It's okay.
I'm Guy Stevens. I used to work with Brian Fisher, Rockstar.
Oh, I'm sorry.
And I just retired from Honda Transmissions October 1st. And rolled on my pension over in April. I'm going to use some of those funds to start some investing. And I've been looking right now. I've got a little bit of money to invest. So first time joining the group. So
awesome. Welcome.
Thank you.
Speaking of guitars, that's pretty awesome. Wish I knew how to play, but I don't.
Yeah, it's been a bad year for playing guitar, so I need something else to fall back on.
Any other first-time people here?
Yeah, so Sam Moore, I'm an insurance broker with Goosehead Insurance. I'm based in Worthington and see a few familiar faces, but nice to be here.
Nice to see you, Sam. Anybody else?
Yeah.
And obviously, Bernie McGuinness, I'll be speaking with you all with FCBank. Been chatting it up for about 20 minutes. So for those who just jumping on, hello.
See you, Bernie. We'll get to you in a second. Anyone else?
Yeah, this is my first time on here. My name's John Steyer. I'm a realtor and investor in Columbus. Been doing property management for about 2 years, transitioning really into sales. I work mainly with investors, but obviously just regular buyers and sellers as well. And looking to build my portfolio as well.
Awesome. Thank you, John. All right, awesome stuff.
Tina needs to say hi.
Tina, we can hear you.
So I think because I'm the one that's like the host technically of this, I can see when people are raising their hand. So I saw Colin was raising his hand, and then I think Tina's new too. So.
Oh, thank you.
So Tina, you were starting, so go ahead.
Tina, you're on mute.
You're muted.
Tap your little box.
It's not showing she's muted actually on my screen. Oh, she just hit, I think, end.
Here we go.
There we go.
Here we go.
Okay.
Hi,
Tina.
Can you hear me?
Yes.
We can.
Awesome. There we go. Well, hi, my name's Tina Wicks. This is my first meeting and recently just joined the group. I am a real estate investor, and even though I live in Columbus, Ohio, I have been investing over in Indiana, and am now going to kind of start trying to invest in the backyard. So I thought I would join some Central Ohio real estate groups.
Nice.
Awesome,
Good to see
Tina.
you.
What part of Indiana you been working in mostly?
I'm originally from Anderson, Indiana, which is just northeast of Indianapolis. So that's where the homes are.
Fantastic. Great to have you, Tina. And Colin, I think, Colin, you're also new?
Hi. Yes. Hi, everyone. My name is Colin Nguyen. I'm actually a new to the group. I'm an out-of-state investor in Virginia, and
Okay.
I got my first duplex in Ohio last month. So I'm looking to network with everyone.
Is that your first rental property?
Yes, it's my first out-of-state properties.
Okay. Do you have properties in Virginia as well?
Yes, I do.
Okay. All right. Well, awesome. Great to have you.
Thank you.
All right. That's pretty amazing, actually, overall, to think that we have, during these times, these many new people showing up for our group. So pretty awesome. Really excited about that. So thanks for joining. Other kinds of things we want to be talking about. Does anyone have any general announcements that they want to share regarding things that are happening either, in the Columbus area, Central Ohio, anything that is think is, hey, be pertinent for everyone else to kind of know about what's going on? Has anybody got any general announcements they want to share?
Just if I could jump in, I'm a little bit of a late to raising the hand, but just wanted to say hi. Been on I think 1 or 2 meetings before, but haven't had a chance to introduce myself. I'm Wakefield, based in California, so similar to Colin, invest out of state. I mainly invest in the Cincinnati area in multifamily, but I, really like the Columbus area and appreciate you guys for putting this on.
Awesome. Nice to meet you.
Fantastic. Anyone have any general announcements regarding maybe an event or local market? I don't know any events going on, but I guess Brian's the guy that always seems to know if anything's going on. So what's happening in Columbus, Brian?
So there's I don't know, Thursday, if you guys know Terry Summers, right?
Yeah.
A lot of you know who he is. He's got a thing this Thursday, actually, but I think out or free tickets sold out for the 19th. If you're part of it, great. If not, I'll feed you back some info next meeting. That's the only thing I know about. Josh, do you know about anything?
Anybody?
Is Josh muted?
Josh Hively, do you know about
I don't specifically know. I guess there is actually, I think Thursday night there's a meetup in Lancaster.
All right.
Profit with Real Estate is the name of that group. That's the only one that I know of. For a while, pre-COVID, I was putting out a monthly newsletter called the Local Meetup Spotlight with all of the local meetings. I stopped doing that for a while, but I think I want to try to start doing that again. So, although it looks like we may be switching all of those meetings, maybe going back to Zoom before too long, but I'll probably start putting that out again, even if they are just all Zoom meetings. At least everybody can kind of see them all in one place. So if anybody's interested in that, reach out to me afterwards.
Kathy?
I have a group called the Happy House Hunters. We meet the first Tuesday of every month. We're on Zoom. We're doing a series of the 6 F's of real estate. We go through it twice a year, and we're starting again in January with finding, funding, fixing, flipping, filling, and finally, what is your freedom number in real estate investing? So it's kind of for the newbies. I also have a calendar of events on my website, and Josh, this is something that might be beneficial. It's simply a Google Calendar, and I put all of the events on there, and it's real easy for folks to just click in, and all the links are right there. I do have the coin meeting on my calendar, by the way.
Very cool.
Maybe a cool idea is maybe putting that on the Facebook, Coin's Facebook, and kind of linking that up so other people might be able to find that and stuff like that, because that'd be an awesome tool. So,
perfect.
As long as Brian doesn't flag you for some reason. Because Brian,
well, and again, it's got some of my events on there, and I don't want it to be just heavy events, but I'm thinking like with Josh, where he's doing a newsletter of all of the dates. Folks seem to like that calendar format because they can kind of see how it fits in with their schedule.
I don't think anything on there would be problematic at all with us. It's just a matter of more networking, more connections. So
thank you.
Thank you.
Awesome. Anybody else got anything else? Amanda, do you see anyone raising a hand? Awesome. All right. Good to know. Well, I'm going to then send it on over to Amanda. She's going to go give us our market update. Take it away, Amanda.
All right. So thanks, Mark. great to see everyone today. And I'm kind of sad that this is our last meeting of the year because I feel like it's going to feel like a long time before we see each other again. But that's how things work around this time of year. So my name is Amanda Roderick. I am a real estate agent with Key Realty here in Columbus, married to Nate, so we're also real estate investors. And I have been doing a little market update in the coin meetings every month the last few months. So really just super quick, a couple of things that have changed. So you'll probably start noticing, if you haven't already, that you're going to start seeing some listings marked as coming soon. So that's something that we haven't been able to do, at least in our Columbus MLS, is have a coming soon listing. So that change happened just about a week or so ago. We had added the ability to have a coming soon. So we're going to start to see listings on the MLS coming soon. You're going to be driving around seeing, you know, signs in people's yards saying coming soon. And it's important to know if you're an investor or a buyer that's on an MLS search, if you're not, you kind of have to have your realtor specifically add the coming soon status to your search, or else you're not going to see those listings. So reach out to your realtor and make sure that they're adding that so that you're seeing all the coming soon listings. It's really just started. I think there's only about 20 or so that are coming soon right now in the MLS, but I'm sure that's something we're going to see happening more and more. So as far as the market itself goes, it's still pretty similar to what we've seen in recent months. So inventory is really down. The last Columbus Realtors report said that our inventory is down by 49%. And based on the new listings for this most recent month, I anticipate that number is going to be over 50% next month. So we're seeing just a definite shortage in houses listed for sale, which is causing prices to continue to rise. It's not super consistent though throughout the whole market. So I kind of mentioned this last month that we're seeing some areas be a little hotter than others. And generally speaking, it seems as if kind of the downtown area is a little slower. So as of right now, like of all the listings that are in the downtown zip code 43215, only 19% of them are in contract, compared to, for say, one of the higher examples, Reynoldsburg, which was in August of this year was named one of the hottest zip codes in the whole country. Right now, 85% of the homes that are listed on the market in Reynoldsburg are in contract. So it's definitely not, you know, consistent market to market. So it is kind of, different markets are reacting differently. The last thing I kind of wanted to touch on is just that another thing, this isn't necessarily market related, but it is definitely industry related. Columbus City Council is talking about making source of income the protected class in real estate. So that means for people who are landlords, you won't be able to say that I don't take Section 8. You'll have to take it if this is passed. So the city of Bexley recently passed a similar legislation. And I know that it's going to be voted on in the next few weeks. And I know that Columbus Realtors expects that City Council will pass it. So it's just a matter of what that's going to look like and if it will get passed and how quickly. So it's just been encouraged that people, you know, if you have feelings on that topic, to reach out to the city to voice those. That's all I got this week or this month. Thanks everyone for coming to the meeting. And I think we should move on to our topic, our main speaker.
Fantastic. Thanks, Amanda.
Oh, we actually have Nick, I think.
Oh, we do got Nick.
Yep.
Nick, member spotlight.
Hey guys, Coin is starting a new segment called Member Spotlight. I'm gonna get some lights. It's gonna be amazing. This is just kind of our way to acknowledge people who are doing what we do and kind of sharing the love and excitement that is going on in the city. This month's Member Spotlight are the Hiveleys, Josh and Caitlin Hiley, who are here.
Welcome to the show.
Guys, go ahead and introduce yourselves real quick, please.
Sure, yeah. I'm Josh.
I'm Caitlin.
We're real estate investors here in Columbus. We're local.
All right, I have a few questions for you. Can you tell us your primary strategy for implementing how you make money in real estate today?
So right now, what we've been doing for the past year is a lot of transactional stuff. So we've been doing flipping and wholesaling and a little bit of wholetailing, if you know what that is. And ultimately, our goal is to buy and hold. We'd like to have more rentals, but in order to buy rentals, you have to have capital. So we're flipping right now to build cash.
I hear that. I'm in the same boat. What role has networking played in doing some of the deals that you've done? Specifically Coin.
Yeah, I would say like a lot of our business is built on networking. That's something that I spend a lot of time doing. Coin specifically, a couple of things that come to mind. Coin was one of the first meetings that we really started going to when we decided to get into real estate. It's kind of been, I guess it's been a staple for us. There's been a lot of other meetings kind of come and go, but Coin's been around, so that's nice.
I think one thing too that's cool about this is when we first started going to Coin meetings, we didn't own any real estate at all. We had just started when we came to this group, and now, I mean, how many deals will we have done this year? So I think it started at Coin, which is cool. But like Josh was saying, I mean, sorry, I cut you off.
No, it's okay. Yeah, I mean, Coin specifically though, like I know, for instance, like the attorney that we work with, Michael Geffert, is somebody that we met through Coin. We've done some deals with some like mortgage stuff with Mark Cady. That's been a great relationship. We've got a couple of our buildings have insurance from Liz with Huskett Ewan, who we met through Coin. Those are the first kind of couple that come to mind. More generally speaking, though, networking just kind of in general has been really good. We've met a lot of the private money lenders that we work with. So we've done about 95% of our deals with private money. So that's all stuff that is, those are relationships that are built via networking. And we have just kind of, I guess, like help and advice from other folks by knowing people in the group. Like, I know, like I talked to Brian Fisher a week or two ago about some particular thing that I was trying to figure out, and he kind of helped with that. So just kind of knowing people has been helpful. And subcontractors as well. Those referrals are always nice when you're in a bind and need a tile guy or something. It's nice to have a couple people to reach out to.
Awesome. Can you two tell us, I know you've done a lot of different types of deals here, and we all kind of find our place in the real estate world because there's a dozen different ways to make money in real estate. If you could go back 2 years and give yourselves some advice, what would that be?
I think in the beginning we were just nervous. So I think we passed on some deals in the beginning that now probably would have been really profitable. A lot of that has to do with how good the market's been. But I would say to just jump right in, buy something, even if the first thing you buy isn't a great deal, it doesn't matter. What matters is getting started. That's the most important thing, because if you never get started, then you never get started.
Great answer. And then real quick, something interesting and unique about yourselves that's completely unrelated to real estate.
Yeah, I think like the one thing that I always like to share, I'd say like the 8 years prior to me getting into real estate, I worked on zip lines for a living. We also have an 11-week-old baby who's here with us.
She's not happy right
now. But yeah, so some of that, and Caitlin and I are just like avid outdoors people. We like traveling and kind of adventure sports like rock climbing and white water, that kind of stuff.
So if any of you guys ever want to go adventuring, rock climbing, backpacking, we'll go with you.
I need a new mountain biker because Nick keeps breaking ribs.
I don't have any more ribs to break at this point. Thank you guys so much for sharing. And I know this is gonna evolve as we move forward at each meeting, but we love to hear from anyone who has some new exciting deals that are brewing, who just want to chat about real estate. We encourage everyone to kind of interact with each other so that we can showcase you and make introductions that are going to help you grow your business. So if there's something in your universe that you need, reach out to our leadership team and we can potentially help make that introduction for you guys.
Yeah, on the email you got for this meeting, there's a link for you to recommend yourself to be a spotlight or someone else. We'll start a spreadsheet and then we'll just go through it so that you can like share who you are, what you do, and hopefully we can help you get done what you need to get done.
Great job, guys. Thank you.
Awesome. The first time for that new segment, and I really enjoyed it. I think it was really a lot of fun. So awesome information. And I've known Josh and Caitlin for a little while, so just a little shout out. Those guys just really blow my mind because, they got 11-week-old right now. They just jump in and do things. And Caitlin was right. You just start doing it. And these guys have been the epitome of that. Just make it happen. And they are definitely rock stars in terms of just trying to figure this out and make it happen. And if you really are new to this and you don't really know their whole story, because this is a little segment, reach out to them because I think there's a lot to learn from both of them. So thanks for them sharing.
Congratulations on the babies, guys.
Yeah. Now let's get into our speaker for the night. I am a mortgage lender, so I'm a geek about this stuff. Really love anything to do with finance and the whole lending process. And a lot of us deal which what I hear is private money lending, hard money lending. That's like a big part of what real estate is sometimes. And then there's kind of like what I kind of do, which is residential lending, which is kind of the boring part of lending. But there is this great part in the middle called commercial lending, where it's stuff that's not, doesn't kind of fit both facets a little bit. And that's really what our speaker is about today is, another part of the whole lending process that honestly is really underserved. And I'm going to let Bernie kind of speak of that. But Bernie McGuinness, he's from FCBank. He doesn't know this, but I've referred a ton of business that way. I'm trying to find out if that's important to him or not. I do keep my head to the grindstone in terms of trying to understand who's doing what, because sometimes there's things that I can't do or there's the best fit, and FCBank is actually the name and local Columbus for doing that commercial lending in the investor market that is really underserved because a lot of banks just don't want to do it. So without further ado, I'm going to go ahead and pass you off to Bernie. Bernie from FCBank, take it away.
Thank you, Mark. Good intro. Appreciate that. And thank you to Amanda for the invite. Yeah, good to see everybody. It's kind of funny. I told Amanda that I'm not much of a visual person, but yet today I spent an hour and put together slides. So I'll share my screen here in a minute. I figured if I didn't do that, I would start wandering off topic and just blathering about nothing. So I kind of wanted to put a visual together just to keep myself on point with my conversation. I'll try not to put you all to sleep with banker talk, but I thought that my goal is really to just share some information with you to give you a lender's perspective in terms of how to finance investment properties. As Mark said, there's not a lot of banks in town doing it currently. Most of the banks that are doing it are community banks like FCBank. I've worked for multiple larger banks over my career. To Mark's point, most of them got out of investment property lending after the recession in 07, 08, and 09. So it's really just about finding a relationship with someone that can do that. I'm going to talk through some different topics that I hope you'll find useful. Hopefully it's new information to you, just to give you some nuance and some underwriting info in terms of how banks look at investment properties. There's pros and cons to doing commercial lending with the banks. I'm going to try to walk through some of what the positives are, what some of the pitfalls might be in terms of making sure that if you are seeking financing for an investment property, that you find the right fit. It's definitely about finding the right fit and finding a lender, whether it's a bank, obviously private money. Find the right lender that will allow you to accomplish your goals. So with that, I'm going to try and share my screen. I don't know if I do that, I may not be able to see any of you anymore. So if anybody has a question, I will lean on you guys to just interrupt me and tell me if there's a question, because if I share my screen, it's going to be on PowerPoint. I don't know. Amanda?
Yeah, if you have a question, go ahead and please submit it through the chat. And then at the end, we can just kind of scroll back through those and call you out to ask those questions.
Who's the host? I'm getting a message that says the host disabled participant screen sharing. Do you know how to fix that?
Okay. Not. I don't.
Amanda, go clear to the bottom. You should have a thing under security.
Okay.
At the bottom of your screen, and there's a place there you can allow him to share.
Thank you, Kathy. Awesome. It takes a village to run a coin meeting.
Should I be good? Okay. Oh, wow. What's this all about? Okay. Well, good. I can still see you guys then. Some of you anyway. All right. So just like I said, just threw together some slides to help me guide the conversation. And like I said, if there's questions, just somebody interrupt me. I'm not easily offended. So yeah, just my personal information for those of you that want to take note, that's me. Our bank office is here in Worthington. So even though I have been spending a lot of time at home as of late, my office location is here in Worthington, 600 North High Street. For those of you that know Worthington, we're right next door to City Hall. Pretty easy to spot us. We've got a pretty sizable building here that we've been in for about 4 years. So that's me and my contact information. And I can swing back to that as we move on, or at the end, I should say. Always feel it's important to throw some disclaimers out there. I work for a publicly traded company, so this is my disclaimer mode. Just FYI, the topics I will discuss are based on my own experience as a commercial lender. Please don't take what I'm telling you as uniform policy or guidelines with all banks and lenders. Everybody's going to have their own policies and guidelines. I'm just going to try to give you all just some information that I feel will be useful based on my experience. Anytime you're dealing with a lending discussion, obviously all decisions are subject to qualification. The bank has not approved this, so this is just me. And thank God 2020 is almost over. So I'm sure we'll all be happy about that. Just a brief summary of who we are as a bank for those of you who may not be familiar with who we are. We are FCBank. We're a division of CNB Bank. For those of you that have been in Central Ohio for a while, we are formerly Farmers Citizens Bank. That was founded up in Bucyrus over 100 years ago. And then Farmers Citizens was purchased about 7 years ago by CNB Bank, which is headquartered in Central Pennsylvania. So CNB Bank is a publicly traded company. We've got about $4 billion in assets. Our geographic footprint is Central and Western PA, Erie, PA, Buffalo, Northeast Ohio, and obviously here in Central Ohio. Our 3 locations in the Columbus market are Worthington, Grandview, and Dublin. We've also got a couple offices up in that Bucyrus area. So all in all, in Central Ohio, I think we have 7 locations. But here in the city market, Worthington, Dublin, and Grandview. And then we are a community-focused bank, or we do place heavy emphasis on relationships and community outreach. For those of you who may be familiar with the Worthington market, we're pretty much everywhere. We sponsor just about everything. So you'll see our logo in a lot of places in Worthington and soon to be in Grandview because we just opened our office there. So that's who we are. That's me, just so you know who's talking to you. Been in banking here in Columbus for 16 years. It'll be 5 years at FCBank. I've held a myriad of roles in banking. I started as a personal banker. I've been a branch manager. I've been a district manager. Done some investments. I was licensed Series 6 and 7 at one point, so I've kind of done a little bit of everything. Went to Allegheny College over in Meadville, PA. Got an MBA from Franklin here in Columbus, and I live in Powell with 3 kids. So this evening is a nice getaway from my 6-year-old twins and my 2-year-old daughter. If I was at home, I would be listening to somebody complain. So thank you for the invite. So really just want to get into some commercial loan basics. Like I said, I want to keep this kind of a high level overview I don't want to get too technical with you guys. I just thought maybe I would share some general concepts, general terms that you should be familiar with if you're going to seek financing from a bank. So, when I'm doing loans secured by investment real estate, 9.8 times out of 10, title to that property is being held in the name of an entity. So the buyer will be putting that piece of real estate into an LLC, partnership, etc. When you're borrowing that money, it's the entity itself that borrows the funds. So the loan is made to that LLC. And the individual owners of that LLC sign what's called a personal guarantee, which basically means in the event of a default, if you go to court with the bank, the bank first makes attempts to collect from that entity, and then by signing a personal guarantee, the bank more or less, in layman's terms, still has rights to sue you. So even though the entity itself is borrowing the money, the bank will require you to sign a personal guarantee as the owner, and that is pretty much industry standard. Just trying to give you some background there. The good thing about commercial loans is more often than not, I can speak to FCBank. I know most other banks, commercial loans don't report to your individual credit report. So that's a good thing. So, for those of you that may own multiple properties and have, mortgages on all of those properties, if you're holding those in your personal name, those are on your personal credit report. And sometimes that causes, debt to income issues qualifying for residential loans. So with commercial loans, the good positive to that is they don't report in your credit report. So, obviously it's your job to disclose those to other lenders, but they don't report it. So take that as what it is. But with that in mind, when we're making a loan, even to a business, the individual credit of the guarantor is still very important. So, there's not necessarily, like in Mark's world, there's different cutoff scores and different credit scores that you want to see for different tiers of rates and qualifications. It's not really like that in the commercial space. We do pull credit on owners. Obviously, if there's credit issues, that becomes a factor. So you don't get out of that, that individual credit piece. It's still a factor. Experience also matters when we're talking about lending to investment real estate. Just speaking from my personal experience in FCBank's lending philosophy, we place emphasis on folks that have been doing it and have a track record of doing it. Sometimes it's difficult for me to lend to a beginner, unless they have significant cash equity to put into it. So, you could all define experience your own way, some of the difficult things for me at times are just getting that person that, hey, it's my first flip. That might be a challenge for me, but, there's ways to mitigate that. If it's somebody that has a good cash position and they're not taking on, a lot of debt related to the project, that might be a good way to get around that. But, experience does matter. Most of my customers that I do deals for have rental portfolios, or they've done a good amount of flips over the years, and they've got a track record that shows up in either in their tax returns or financial statements for their LLC. With commercial lending, I would say, regardless of what bank you deal with, be prepared to establish a relationship with that bank in the form of deposit accounts, checking accounts. That's very important. If I'm doing a loan for rental properties, more often than not, we're really you can't necessarily require, but it's highly encouraged to have that account at the bank so that we can see that those revenues coming in from rents, collect those rents through a bank account here. Or if we're doing renovation funding, having a bank account here at the bank where we could disperse funds to and monitor how those funds are being spent. And that's more of that's definitely a community bank relationship requirement. We're not the Chases and the Huntingtons of the world that have, all these different sources of revenue. we're a smaller bank, so we've got to be able to fund our loans through deposits. So having those relationships with folks really is helpful for us to be able to do what we do. Any questions on any of that stuff? Pretty general overview. Equity is one important concept wanted to discuss. It's kind of your skin in the game. Being able to put cash equity into a deal is very important if you're seeking bank financing. I put cash as king. It's discouraged. If I'm being presented with a real estate deal, if there's other investors that are in that project, or subordinate debt, meaning like, if you're buying a property for $200,000 and you're not putting any of your own cash into it, but you're gonna have a $50,000 seller note. That's kind of a second mortgage there. That's not something that banks generally like to see. The cash equity is definitely encouraged. Just because the more debt you carry on a property, the less margin you're gonna have. It's just obviously going to eat into your profits. And then obviously, the more you're lending against a property that's going to be a rental, the more of that cash flow is going to go to service debt. So we really like to see 20 to 25% in terms of equity. I'm going to talk about a couple different concepts in terms of project equity and purchase equity, because the two scenarios that I deal with most often is just a straight purchase of a turnkey property that's going to be a rental property, or a purchase with renovations. So we kind of look at both of those as two different. I look at those as two different scenarios where if you're just buying a rental property that's going to be a turnkey property, there's a tenant in it, just a straight purchase, it doesn't require a significant renovation. More often than not, I'll require 25% equity on that. So if it's a $100,000 purchase, obviously we'd expect 25,000 cash equity to be contributed to that. One thing I will say on the equity, a couple lines above there, I said, investor debt and subordinate debt is not encouraged. However, I do have a lot of customers that may have, home equity lines of credit on their home, on their primary residence, that they use to sometimes put money down into investment properties. That's okay. That's your equity. That's a legit source of equity for me. And that is expected to be contributed up front. So, if you're doing a purchase, obviously we expect that money to be paid at closing. And then on the equity front, loan to cost versus loan to value. Those are two concepts that I'll cover here on the next couple slides, and how they relate to what a bank would expect you to bring to the table as far as cash equity. Does that make sense, everybody? As far as equity, okay. Big piece of the pie, especially with investment real estate. Just to compare apples to apples, obviously in the residential lending space, there's a lot of first-time homebuyer programs out there. There's FHA programs that allow home buyers to get into a house safe, with as little as 5% down. Those type of programs just don't exist in the commercial world. And the reason for that is all of our loans are done on a portfolio basis. So that's just the way it is, I guess. Moving on. I mentioned loan to cost and loan to value on the previous slide. Those are two concepts that I talk a lot about with customers. When I'm talking about loan to cost, I'm really referring to either new construction or a purchase and renovation deal. So whether that's going to be a flip, or if it's going to be a purchase, rent on hold, it doesn't make a difference. And I use an example there. So just, you can see that example. Say you're getting the property for $100,000. You're proposing $50,000 in renovations. You're gonna have a $150,000 total project. from my perspective, in terms of how I do my business, depending on the qualifications of the borrower, we're usually good being at 70 to 80% of total costs. So hopefully that makes sense. So if you, approach FCBank and say, hey, I've got this deal here, looking to acquire this property, it's going to cost us $100,000 to acquire it. And then here's our renovation budget. This is the work we have to put into the property. I view that as a $150,000 project, which we can lend according to that loan to cost. Hopefully that makes sense. That's a little bit of a different concept than loan to value, which is my next point. Loan to values just simply refers to the loan amount divided by the purchase price of the property. So there's two different concepts there. If you consider concept of loan to cost, if that was just a $100,000 purchase without renovations, the most I'd probably be able to finance would be $75,000, because we probably want to be about 75% loan to value on a purchase. Whereas on a deal that's going to involve renovations, we could typically extend a little bit more, maybe up to 80% of that total project cost here that I'm showing you guys, which, if you're talking whether it's going to be a long-term rental or a flip, that allows you to take on a little bit more leverage in terms of borrowing against that property. So hopefully that makes sense. If there's any questions, let me know. I have found that loan to cost is a concept that not a lot of banks use, unless it's just ground up construction. If you're talking about dirt to a structure, loan to cost comes into play a lot in new construction. But the way I could do things is a little bit unique in terms of doing that with a investment property.
Hey, Bernie, it looks like Wakefield has a question.
Go for it. Okay.
Yeah, I had a question on the renovation budget. So in your example there, 50K, is that something that you assess with a contractor bid or investor estimate as they're looking to buy this property and say, X dollar for external interior renovations? How do you do that?
Yeah, great question. I assume that would be a question. That's a good one. Yeah, I like to get as much documentation as possible. It really depends on the size and scope of what that renovations are going to be. One of the first conversations I typically have with borrowers is what's your plans for the property, what work needs done. If it's mostly cosmetic stuff, like flooring, carpet, paint, that type of thing. If it's just a quick 20,000 cosmetic improvement, I'm not going to require contractor bids for that, obviously. But I mean, from my perspective, dealing with somebody that knows what those true costs are going to be is very important. The one mistake I see a lot of folks make is not having that budget number tight enough on the front end. I've seen a lot of times where folks get into a property, they think their budget's going to be 30 grand. They haven't properly vetted that number before they get into the property, and all of a sudden that 30 grand turns into 50 grand, and you're 20,000 down before you even list the property. So if it's going to be a flip, especially, making sure that budget is tight. If you're going to be using outside contractors for that work, I generally like to get documentation of that, whether it's the bid they've provided you, if you're signing a GC contract, getting as much documentation as I can, so that when we advance a draw for that deal, I know where the money is going and there's no surprise. Hopefully that answered your question.
Bernie, it looked like John Steyer had a question also.
Sure.
Yeah, thanks, Bernie. Do you find that when you're going through the process with maybe a new client or one you've worked with, that they come to you with a deal in mind, or is it more like residential where you might just be pre-approved and searching?
Yeah, good question. There's no quote unquote pre-approval in my world per se. I deal with both of those scenarios. I generally tell folks that are, you know, kind of shopping around. I kind of give folks a checklist of the financials that I typically gather from people, and just say, hey, if you're willing to share some personal financial statements with me, I've got a pretty extensive document, a personal financial statement document that I have people fill out. It's kind of a detailed assets and liabilities statement. At the very least, if you could, you know, fill out one of those for me, I could give you a good indication of what I might be able to do. It's not, you know, it's not like I guess you could call it a pre-approval if you want, but if there's not a specific, you know, if there's not an imminent deal, I'm totally fine having conversations with people and say, hey, I think I could get this done for you, or no, I don't think that's a good fit. It's just all about conversation and getting to know the customer and what their goal is. And if you're willing to share that kind of stuff with me up front, I'm usually pretty good about telling you what I can and can't do. Does that help?
Yeah, that's great. No, I appreciate it. Thank you.
Okay. I can't see everybody, so it's hard for me to see if somebody's nodding at me or not. Okay. Well, if everybody's good, I'll move on from that topic. So I did loan to cost, loan to value. Loan to value, the two concepts tie in together. So, you know, if you're talking about a project that's going to require a lot of renovations, you know, we're going to look at that loan to cost, and then we're also going to want that cost to be substantiated by an appraisal more often than not. Depends on the size of the project, but let's just assume that we're going to require an appraisal. So, you know, if using that scenario, if you're getting into a property for $100,000, you know, that's obviously the market value of the property that day, the contract price. The market is determined, it's a $100,000 property. But with that renovations, we want to know, all right, if you're telling me you're going to sell it for $225, am I able to get an appraisal that's going to tell me it's going to be worth $225 in 6 months? So being able to provide that renovation information, not only to myself, but to an appraiser, is very helpful. Oftentimes, a lot of the customers that I deal with will bring comps to me. I'll have a good sense of the property. So if I'm dealing with a property, say in Marion Village, you know, I've done so many properties in Marion Village, I know what that market is commanding right now. So, you know, somebody tells me they're going to sell a 2-bedroom, 2-bathroom house in Marion Village for, you know, $275,000. You know, 5 years ago I told you you're crazy, but today, I mean, that's kind of, you know, what's going on in that market. So it depends. If I'm familiar with the market where that property is, I might not have to have a full appraisal done if I could get as much information from a comp perspective and we feel good about what we've been presented by the customer. But more often than not, we'll want to get an appraisal done, and that kind of ties into the loan to value. More often than not, we'll probably want to be at no greater than 75% of that as complete value. So it's kind of whatever the lesser. So if you're telling me, you know, so if you go back to this scenario, loan to cost. So let's just say I approve this customer, you know, for 75% loan to cost. That's $112,500. You know, we'll want that 112.5 to also be obviously 75% or less of that as complete loan to value. Does that make sense? It's two different numbers. Does that make sense to everybody? Normally what makes a good deal for me is when I'm at, you know, 75% or 75 or 80% loan to cost. And when I get an appraisal done, it shows my as complete LTV as like 55. That's when I know I'm working with a real solid deal, where I know that I could be confident that customer is going to be able to list that property for a specific price and get that price and still have a good wiggle room. And if the deal goes to hell, the bank won't have a problem selling that house and getting our money back. So that's kind of the two concepts there with loan to cost and loan to value. Hopefully that makes sense to everybody. Two big concepts that I speak in depth with people. What else? I don't remember all my slides. So here's another example scenario, kind of broke it out here. You know, purchase price 100,000, reno budget 75, total cost 175, and then it appraises for 225. So that's kind of where I'm at. So I'd have an approved loan for 140 or 80% of cost that results in an LTV of 62%. Does that kind of make sense to everybody? Seeing that 62% LTV on the as complete number is good. All right, commercial loan structures. This is where Mark and I will geek out together. So the big thing that I definitely want to educate people on is commercial loan structures, because they're not what you're used to with residential financing. Like, I don't know any banks that can offer it. I can't offer a 30-year fixed rate loan. It's just not something that I could do through commercial financing. So commercial options vary from bank to bank. That's why it's important I would tell everybody, figure out who in town's doing it, who offers what terms, what's rates, and what makes sense for you. More often than not, the longest I could go is a 20-year amortization. So, you know, if you're talking about a buy and hold property, and I'll get to this on the next slide. It's all right. If you're going to take a loan with a 20-year amortization, does that payment meet your cash flow goal, right? Or is it appropriate to find somebody that would offer you a 25-year or 30-year? Because condensing that loan term, that amortization down to 20 years, that could have an impact on your NOI, your ROI, and your cash flow. So it's important to know what structures are available. So it's pretty hard to get that 30-year fix on a commercial loan. It's just not. I can't even do it. You know, I do corporate banking as well, and it's not even available in those scenarios. So.
Hey, Bernie, this is Nate. Just real quick, is 20 years the most common amortization that you're working with then, or does it go shorter than that?
15 and 20. Just depends on the customer and their, you know, depending on what their portfolio looks like. I have customers that have, you know, significant portfolios where, you know, they could afford to do a 10 or a 15-year am on a certain property because they've got excess cash flow coming from other properties. So it just kind of depends on what the goal of the deal is. But okay, but yeah, you know, with commercial financing, you know, understanding what an adjustable rate mortgage is. The most common loan product that I write is what's called a 5-5 ARM, which means, you know, your rate is fixed for the initial 5 years. You'll have a rate adjustment after 5 years, and starting on that month 61. You know, if you're talking about a 120-month loan, your rate's going to reset at month 61 and be fixed for another 5 years. So that's a 5-5 ARM. Different banks use different indexes to determine what those rates are. You know, if you follow the financial news, that, you know, the 30-year mortgage is always pegged to the 10-year Treasury bill. You read that in the financial news all the time. The commercial rate indexes are a little bit different. I won't get into the nuance of that, but rates are determined a little bit differently in the commercial space. They're usually a little bit higher than residential consumer rates. You know, so if like right now, you know, you get a 2.75 residential mortgage. It's like, I don't have anything that low. You know, most of the investment properties that I'm doing right now are kind of in the 4.5 to 5.5 range. So just different rate structures and whatnot on the commercial side. This bullet point, maturity versus amortization, is important. Again, I don't want to speak too technical here, but I personally, in my role, can't offer what's called a fully amortized loan. So what that means is I could give you a 10-year loan. Your payment will be based off of a 20-year amortization, but in 10 years, your loan is going to mature and you're going to have a balloon payment. You're going to have a balance due. I just can't, in my product set, what I have at my bank, I don't have like a 20-year fixed rate loan. So you're going to fall into that 5-5 ARM, 10-year term with a 20-year amortization. Does that make sense to everybody? Because that's a concept that's new to some folks. You'll basically have a 5 or 10-year loan The payment will be based on a 20-year amortization, but at some point before the end of 5 years or 10 years, depending on what we give you, you're going to have to refinance that loan. But my experience with investment properties is that doesn't really make a difference to most folks. A lot of the folks that I deal with, their portfolios, I don't want to say they're volatile, but they turn over fairly often. So a lot of the folks that I deal with that have rentals, those aren't usually properties that are going to be in the portfolio for more than 5 or 10 years anyway. So it's not much of a deal breaker with a lot of the folks that I deal with.
Bernie, we do have a question from Art. Art, did you have a question for Bernie?
Yeah, so on we have a number of the commercial program or different kind of properties and groups and step downs. I was more interested in how you guys look at or structure your step downs as you're kind of putting those in as it relates to the prepayments, if any.
You just want to speak to the prepay?
Yeah, just kind of, I'm assuming if that, because at least, I don't know, and this is more of a general question, is kind of the considerations on the commercial side, you tend to be more on the prepay or step downs and other factors on how you structure.
We're pretty common sense. We have generally, air quotes, generally, our loans have a 2% prepay if you refinance it with a different bank. But if I've got a customer that's selling a property, I'm not going to charge them a prepay. It's just not applicable. And I could do different, I could play around with prepays. Like I could do a 5, 4, 3, 2, 1. I could do declining scale, prepayment penalty, things of that nature. But generally speaking, our prepay usually only refers to as if you refinance with a different outside lender.
Okay, and I guess a follow-up to that one is the release provisions. So if you're doing the portfolio loans, how do you guys look for structure?
Yeah, no, that's a good question. I have a lot of those. I'm assuming you're speaking to maybe a deal where I'm holding 5 or 6 properties as collateral and you decide you want to sell one. Yeah, it's just
exactly.
What I do in those scenarios is kind of go back to that original approval, kind of figure out where the numbers were then, where that loan balance is now, figure out what our aggregate loan to value is, and work with the customer to figure out a number. What principal reduction do we need to have on your loan balance to release that property? Or do you have another free and clear property you could give me that I could replace it with of equal value? Does that make sense?
Yeah, so you guys don't actually have, you don't look at pre-structuring the percentage of association per asset up front in the loan. It's at disposition.
Yeah, I'll look at, if I'm writing one loan secured by 5 properties, I'll look at the aggregate loan to value. But no, I don't necessarily place I don't divvy it up like you're talking about on the front end, if that's what you mean. Determining on the front end, no, not usually. Hopefully that answered your question.
Yeah, thanks.
Yeah, it's in those scenarios, it's more of what are we working with at that point in time where we might need to release that property. How am I on time, Amanda?
Looks like we just got probably 5 more minutes here, Bernie. We should probably open it up.
Doing good.
Okay. Last thing I want to talk about is just property cash flow. If you're gonna have a property that's gonna be a rental, obviously it's important for you to know how a lender is going to evaluate cash flow. Key concept in my world is debt service coverage. So I kind of wanted to just walk you guys through what that looks like. Here's just a good example of a property cash flow and kind of how I underwrite a specific property. So if I have a customer that comes to me and says they've got a property in contract for 107, and I was just throwing these numbers out of the blue. Trust me, I didn't know how these were going to turn out. But if I have a customer that comes to me and says, "Hey, I'm in contract on a property for 175,000. We're going to put 25% down." And they're requesting a loan at this amount at this rate on a 20-year amortization. That's going to be a payment of about $830 a month, principal and interest. That's just a simple mortgage payment calculation. So, and then I just kind of do a breakdown in terms of what those gross rents are going to be. It's very helpful to have seller financials on some of these if we can. Obviously that's hard to obtain at some more often than not. So generally I assume a 35 to 40% expense ratio, which kind of gives you gives you a net operating income, and then annualize what that debt is. And that's kind of where you get a debt service ratio, if that makes sense to everybody. On this specific example, that's really low. I probably wouldn't be able to do this, which ties into my next slide, 1.08. Generally, I know with me, we want to see at least a 1.3 or better, which basically means for every dollar of debt, that property is producing $1.30 in revenue. So again, I was just throwing out numbers and I was putting this together earlier. So in this example, what does that tell me about the property? You know, can rents be increased? Are we overstating or understating expenses? Can the customer find a longer amortization? You know, what's your target cap rate? You know, in this example, when I just did the math, you know, that property's got a cap rate of 6.2%, which, you know, for a residential property is pretty low. So, you know, just a kind of a quick example there of you know, how we look at a property and its ability to service whatever debt the customer is looking for. And I do that on individual properties, and I'll do that on a customer's entire portfolio as well. So in this scenario, say for example, if I've got a customer that I've done a lot of deals for, it's a relationship customer, and you know, maybe this property isn't hitting the threshold we want to see, but does their portfolio kick out cash at a 1.5 ratio? You know, that might be a way to mitigate this scenario. So that's all I have. So yeah, hopefully that was helpful. If there's any other questions.
I guess if there's no, I have another one too. I guess
Yeah,
one of the questions too is always looking at kind of community commercial lending versus agency debt. And is it normally seen that you guys keep it at like, hey, if it's $1 million and below, then obviously that's kind of the sweet spot that you guys focus on? Or are you also seeing other ones where it's more of the portfolio larger than $1 million where you can't get the traditional agency debt?
Well, everything I do is portfolio. All of the loans are held on our balance sheet. So I don't really get into agency debt. So if I'm going to do a deal for a customer, it's going to be held on our books. I mean, we've got a pretty significant lending limit, so I don't really ever run into scenarios where it's going to be too big for me to do. I mean, I could do 30 million if I needed to. So it's not something that we'd have to go outside of our four walls per se.
Hey, Bernie, there was a question there regarding, can you talk a little more about the debt coverage ratio or debt service ratio? Because that's something that I know I try to explain a little bit to people, but I know it's a confusing thing. And I know it's also, people like boxes. And I always try to explain that commercial lending and portfolio lending is not always in a box. It's about how does, you know, sometimes the bank can make their own determination on some things. For example, the expenses, sometimes it might be 35, might be 30, might be 40. Talk a little bit more about I'd like to call it massaging the loan. And I know in commercial loans, you can massage it sometimes a little bit more.
Yeah, you're absolutely right. And in this scenario, I tried to just use kind of a very general example. I guess, you know, I deal with a lot of different property types. So, you know, I try to be as simple as I can for, you know, a single family residence or a duplex or a four family. Where'd my stuff go? See that?
Sorry, Bernie, that was us.
Oh, no, it's okay. So it's the best way I can answer that question, Mark. You know, if I'm dealing with a situation, you know, there's different property types and different scenarios. So say, for example, if I'm financing a storage facility, right? When I'm doing a storage facility deal, I'm going to have at least 2 to 3 years of financials from the seller that will paint an accurate picture of what the history is on that property, what kind of revenue it's generating, what's the historical vacancy, and if it's got a lot of vacancy, what's my customer's plan to get it to, full occupancy. That's a different scenario. It's hard with a residential property sometimes. The only thing that I know for sure that the customer is going to have to pay is taxes, insurance, and then, realistically, what's that expense ratio going to look like? So to your point, can we massage that a little bit? I mean, yes, it's all case by case, but I mean, generally, if you're telling me, hey, this is what the rents are, this is either the lease that I'm assuming with the purchase, or this is what I'm going to market the rents for. Oftentimes, I've just kind of got to do a projection.
I'm going to go ahead because I think I got like 6 or 7 questions here, because a lot of the stuff that I sometimes run into is people asking me about stuff, and I'm like, hey, I can't, but maybe these things are out there. So I'm just going to kind of run through a lot of them. You just kind of, answer them as you got. First, you guys do blanket loans on investment properties.
By blanket, I'm assuming the question.
One loan, multiple properties.
I can.
Okay, excellent. And if those people who don't know what a blanket loan is, like maybe I have like 3 rental properties, but I want to get one loan on all 3 of them.
Right. And to further clarify that scenario, right now, obviously the economic climate has impacted some of the things that I can and can't do. Currently, in that scenario, I can't do a loan like that if it's going to be for cash out purposes.
Okay.
So I can't recapitalize an investment property right now.
Okay.
With that, I have a question real quick, Mark and Bernie, with that. And with that blanket loan, like what I just did with you, right, Bernie, on the 3 properties that I've got.
Yes.
It was we had a 5-5-5, correct?
Correct.
Not just a 5-5 like you talked about earlier in the presentation.
Correct.
And that was to full maturity.
Correct. I was able to offer you that full 15. So again, I'm speaking in a lot of generalities here. Every situation is a little bit different. But if sure Brian's okay with me disclosing, he just said it. He just Brian just bought some rental properties, and I was fortunate to get introduced to him through another customer. And we did a similar structure that I've spoken to here, where we were comfortable. What did we do, Brian? 2 properties or 3? 3. So yeah, we're basically at 75% loan to value on 3 properties.
Well, 3 doors, 2 buildings.
Yeah.
All right. How about home? Are you doing any home equity lines of credit on investment properties right now?
No, unfortunately not. No, I can't do any. I can't do a revolving line on investment properties. There's caveats to that. There's the answer is always generally 90% of the time I can't do that. I'm trying to keep it high level. There are certain. I'm sorry.
So you're saying there's a chance?
There is a chance. High level, no. Can I get you into that 10% box, maybe?
Okay.
Bernie, this is Nate. Honestly, kind of what Mark's bumping up against there. I thought the loan that we did was pretty creative, where it was a draw note instead of a revolving line, and that's something I think some people here might want to hear about.
Yeah, well, just in terms of financing flips, I didn't really get into the details of that, but in that, if I go back to this, where's my slide? Where's my loan to cost? Glad to do this today. So if I'm talking about a flip situation, say for example, you're in a scenario where we're dealing with this specific property here. If this is going to be a flip, the way that I could get a little bit creative sometimes and do, like say a short-term interest-only note that has a draw feature. So, say for example, you're getting into this situation here. You want to borrow $112,500, obviously, to purchase it and do the subsequent renovations. We're not going to give you that full $112,500 up front. You're going to put your 20 to 25% equity in at closing. That's going to come off that's going to be your cash to close at closing. and then you'll have a remaining amount to draw over, whether or not we do a 6-month loan or a 12-month loan. And then, you could have interest only payments on that outstanding balance. And then obviously the principal due at maturity. So if you're getting into a flip scenario, that might be a situation that we could accommodate where, to your point, Nate, we did a 12-month draw note, it was interest only, and
yeah, and I just want to point out to the
you just paid it off, so it worked out.
I just want to point out to the friends in the group, it was a 12-month, arrangement, and I was able to get it at 4.5% and have some flexibility on how I was able to use that cash and some time to secure long-term financing on the back end. So even though it was essentially short-term money, we were able to have it at 4.5% instead of 12 or 13%, as some of us are paying out there. So it was
and
arrangement.
And Nate, to that, if I remember correctly, that we pulled cash out of the existing property, right?
What we did was there was a property that we had free and clear, and we used that as the security.
Yeah, that's one of the scenarios right now that I probably can't do because we're pulling cash out of a free and clear property. But I can do that on a purchase still. So, we could fund a purchase through that same mechanism, if you want to call it that, and then still have those funds to draw as the construction schedule moves on. So, say for example, in that scenario, we advance our portion of funds at closing, and then, the customer comes to me with draw requests, submits the documentation I'm looking for in terms of, hey, invoices or what have you, in terms of where those funds are going, so that we can follow the paper trail.
Well, and just another thing to point out to our investors there is that you're only paying once you access the funds.
Correct.
Correct. It's a big deal. Again, if we're used to paying 12% and you get the money in your hand and you're paying it, we had some flexibility there as to when we were going to start using the money, and you don't start paying interest until you start using the money, which is what people are looking for on those HELOCs.
That's pretty good.
So thanks, Bernie. It was great.
Yeah.
Bernie, I got another question here for you. I do a lot of BRRRR situations where people are fixed up their property, they renovated it, and they're ready to put long-term financing in it. But I mean, I'm only lending to people. Some people are in these LLCs and they want to be long LLCs and they want to lend in their borrow in their LLC. So I can't. So in that situation, how soon can you use the current value off of in that BRRRR situation?
Yeah, that's the magic question at this point. There's a lot of uncertainty around that right now. Before plague season, it was usually 6 to 12 months at least. I could maybe cut that down a little bit if we were very confident in the property we were dealing with. Now that's a tough question mark. It's just those situations are harder to do right now.
Okay. Let me kind of put this out there too, because I feel a lot of these questions a lot of times from our coin group and people wanting to have answers. And if you haven't kind of got the feeling here and understand how Bernie's business works, is commercial lending, or what we call portfolio lending. The bank is making up their own guidelines as they go, because they are lending out their deposit money. So where I focus on, I'm doing Fannie Mae, Freddie Mac kind of stuff, and the guidelines are kind of set up already. They constantly are changing, evolving based off of what the market is doing on almost a daily, weekly, monthly basis all the time. So really what you want to do, if you're interested in commercial lending, you got to build a relationship. You got to get to know Bernie. You got to get to know who you're going to do business with and see what they're doing today. Because every lender out there, commercial lender, is going to be doing things a little bit differently than each other. And by the way, they might be changing from month to month.
Yeah.
And they're going to want relationships and understand who you are and look at the big picture. And basically it comes down to this question, because I used to do this a little bit when I worked in a small bank, is do they trust that your money is good, that you're going to pay? Because that really what it comes down to is, do they think you're going to pay, and does the deal make sense? And the more relationship that you build with them, the more they want to say yes.
That's very well said. And sometimes it's hard for me to put things in, it's hard for me to put, a presentation like this together sometimes, because oftentimes I'll get people referred to me and they want a lot of specifics up front. And that's just difficult for me to provide because, in Mark's world, he has specific loan programs that he could qualify customers for and then underwrite them according to federal guidelines. He literally has to fit you in that box for that loan, where I don't have I don't have a product list. I don't have a menu of loans to choose from. I start with a blank slate, and we kind of just go from there. It's tell me what you're trying to accomplish, and let's start from there, and then let's see what we can do. It really is, it's customized. I don't have a, I don't have a product list or anything like that I deal with. It's just, hey, let me see if I can put something together. So to that point, I could not have said that better.
Well, Bernie, thank you so much. I think that was extremely valuable information to a ton of our members. I think that we've covered everybody's questions, either directly or indirectly. If anybody has anything left to say, let me know. But I'll give you a minute or a second. Sorry, a second.
I have one more question, if I can just follow up on a point that Nick made earlier. So, hypothetically, let's say I've got a W-2, I have a house mortgage, I have a couple of rental properties. So what type of, debt coverage globally do I need to hit? And I know you talked about that the property level, I think it's like a 1.3.
Yeah. And again, to my previous point, I don't have a set, a set guideline in terms of a number you have to hit. It's kind of like preferred. So for the property itself that we're lending against, that 1.3 or greater is fantastic. But we'll also look at your personal finances. What's your individual debt to income ratio? So in the event you have a vacancy in a property, can you service that debt on your own through your personal income? That brings up a good point for me. I like to see at least 3 sources of repayment, right? So if you're dealing with a rental property, the primary source of repayment is going to be your rent. If you're not getting rent, can you afford it in another means? So your day-to-day job or other properties that you have. And worst case scenario, if we have to foreclose on that property, are we in a comfortable LTV position where we're not going to lose money? So that's kind of the 3 levels that I look at it. Hopefully that answers your question.
Okay, thank you.
All right, so I think that wraps everything up. Just to recap, there is no meeting in December. So this is the last time we'll all be gathering like this. But again, the Facebook page is available. If anything comes up between now and when we meet in January, post it. And I promise you, there are plenty of people, as you can tell in our group, that love to talk. So we'll weigh in on those situations and give you our opinions and hopefully some good advice. But thanks again for everybody who came this evening. Be well, happy holidays. And unless anybody has anything further, I think we are good to go.
Bye, guys.
Thanks, everybody.
Good night.
Thanks, everybody. See you all.
Thanks, Bernie.
Thank you, Bernie.
Thank you.
Thank you very much.